Welcome to vTalkInsight, Allocator's lens daily for January 30th, 2026. Global markets are leaning risk-on, with record earnings, powerful AI investment, and surging real assets reshaping the opportunity set. At the same time, a cautious Federal Reserve, a weaker dollar, and sharp moves in commodities are creating a more complex backdrop for cross-asset portfolios. In equities, the dominant theme is still a global bull market, but it is becoming far more selective beneath the surface. High liquidity from central banks and strong fiscal support are underpinning risk appetite, and corporate earnings in the United States are running at record levels with expectations for further gains. The combination of resilient growth and productivity improvements keeps the earnings backdrop constructive, even as policy and political uncertainty rise. We also see global risk appetite in price action, with markets like South Korea hitting new highs and a robust pipeline of listings on exchanges such as NASDAQ and in the United Kingdom, signaling investors are willing to fund new equity stories again. Within tech, the AI narrative has shifted from simple enthusiasm to intense scrutiny of winners and losers. Hardware and semiconductor names tied to physical AI infrastructure are seeing record order books, with equipment makers like leading lithography specialists and memory producers reporting backlogs that far exceed quarterly revenues. By contrast, some software and cloud platforms are disappointing, with softer cloud growth at companies such as Microsoft and SAP exposing valuation tension when AI spending is not yet translating into upside surprises. Meta sits on the other side of that divide, with revenue guidance well ahead of expectations and an aggressive multi-year capital expenditure plan that investors currently view as justified by strong underlying growth. Market leadership is rotating away from an earlier narrow focus on mega-cap tech. Equal-weighted indices and small caps are outperforming traditional cap-weighted benchmarks, and sectors like energy and metals-related equities are gaining ground while some large continental European markets remain flat. Flows and positioning reinforce that story. Retail call buying has shifted towards small caps, reaching historically elevated levels, while there is growing institutional interest in Asian technology names in Korea and Taiwan as alternative ways to access AI themes. At the same time, private equity dry powder in the trillions and expectations for stronger M&A, particularly in the UK, point to sustained deal activity that could keep equity risk premia compressed in select areas. This rotation is happening alongside rising dispersion and single stock volatility, especially in big tech, even as index-level volatility remains contained in the mid-teens. Options data suggest retail investors have turned more cautious on broad upside, with less call buying and more call selling around earnings, while still expressing risk appetite in smaller names. For allocators, that creates a market where headline indices may look calm, but idiosyncratic risk is elevated and earnings delivery around AI and Capex plans is critical. Key signposts now are how far leadership broadening can run, whether mega-cap underperformance deepens as long end yields rise, and whether AI capital spending eventually shows signs of overbuild that could pressure margins in later years. Turning to rates, the Federal Reserve has paused its cutting cycle and is signaling a high bar for further moves. Officials describe the outlook with cautious optimism, citing a stabilizing labor market, resilient consumer spending, and solid corporate balance sheets. But they want more data before committing to additional easing. Market expectations have converged toward only 1 or 2 cuts this year, consistent with views from major asset managers that see little urgency for large-scale monetary easing while growth remains above trend and inflation progress is gradual rather than dramatic. Against that backdrop, the debate has shifted toward the long end of the curve. Stronger growth and rising fiscal expansion are putting upward pressure on long-dated yields and raising questions about whether investors are adequately compensated for duration risk, especially in 30-year bonds. At the same time, the end of the hiking cycle and still attractive real yields means some investors are considering selectively extending duration from very short holdings. Updated long-term estimates for a traditional 60/40 portfolio have risen from around 4% to roughly 6.5%, reflecting higher bond yields and more investment in the real economy through fiscal channels. Regional rate dynamics add further nuance. In the UK, inflation is expected to fall back to target, giving the Bank of England scope to ease and helping gilts outperform global peers, with the possibility of more aggressive cuts if unemployment rises. In emerging markets, improving fundamentals and stronger policy credibility gives central banks more room to reduce rates without triggering instability, which supports local bond markets. For allocators, the key watch points are incoming labor and inflation data, any shift in Fed communication as leadership questions evolve, and how far fiscal-driven term premia push long-end yields higher. In credit, the story is one of generally solid fundamentals but growing issuer-level dispersion. Large European banks, such as Lloyds and ING, are reporting strong earnings, robust capital generation, and improving efficiency metrics, with expectations for double-digit returns on tangible equity and cost-income ratios well below 50% in coming years. Credit quality in key mortgage and consumer books remains better than long-term averages, with expected credit losses at Lloyds, for example, running at only a fraction of historical norms. At the same time, isolated events, like compliance probes at Deutsche Bank, are reminders that idiosyncratic risks can still dominate headlines for individual issuers even when the sector backdrop looks healthy. Outside public markets, private credit continues to evolve. There's a clear shift toward more asset-backed and liquid structures that offer improved resilience and flexibility compared with traditional private loans, particularly as investors weigh late-cycle risks and potential AI-driven disruption to legacy business models. Combined with substantial private equity dry powder and strong demand for financing in areas like data centers and infrastructure, this supports ongoing activity but also increases the importance of security selection. For multi-asset portfolios, the balance between capturing credit carry and managing sector-specific risks, especially in consumer-exposed and structurally challenged industries, remains central. In foreign exchange, a weaker U.S. dollar is a key cross-asset driver. Dollar softness, combined with solid U.S. fundamentals, is amplifying returns for U.S.-based investors in overseas markets and has been a tailwind for emerging market equities, local bonds, and currencies. Emerging market central banks now have more room to cut rates thanks to stronger balance sheets and improved policy credibility, which further supports local assets. There's also a growing tendency for non-dollar investors to hedge U.S. currency exposure and seek value outside the United States, reinforcing capital flows into Europe and emerging markets that need large-scale investment in AI, defense, infrastructure, and the energy transition. Beyond the cyclical move, there are signs of structural rethinking of the dollar's role. Some commentators point to a break between the dollar and implied Fed policy, reduced U.S. dollar accumulation by countries like China, and greater interest in gold and other reserves as evidence of a slow drift toward de-dollarization. Yet recent Treasury data show record foreign buying of U.S. equities and hundreds of billions of dollars in other U.S. assets, which argues against a wholesale dollar abandonment. Instead, the shift appears more nuanced, with some reserve holders diversifying into real assets such as gold, copper, and silver alongside currency holdings. For allocators, that raises questions about long-term hedging policy, potential imported inflation from a weaker dollar, and the interplay between FX moves and real asset valuations. Commodities are where the cross-asset tensions are most visible. Gold, silver, and copper have all pushed to record or near record highs, with gold trading above $5,500 per troy ounce and silver up around 60% this year. Copper has seen extraordinary intraday moves, with single-day gains of 8 to 12%, and the broad commodity complex, as captured by major indices, is approaching historic highs. These moves signal both heightened inflation risk and intense demand for real assets as hedges against currency debasement and geopolitical uncertainty. Fundamentals and policy also play important roles. Copper and aluminum markets are facing significant supply deficits, with copper shortfalls estimated in the hundreds of thousands of tons, while demand is supported by U.S. growth, infrastructure spending, and potential easing of Chinese property restrictions. AI and data center build-outs are adding another powerful demand leg, driving record orders for chip-making equipment and robust demand for energy, optical networking, and storage. On the energy side, Brent crude has jumped roughly 6% in just a few days on rising geopolitical tension in the Middle East, reinforcing concerns that higher input costs could spill over into broader inflation. At the same time, there are clear signs of speculative activity and late-stage dynamics. Some of the most dramatic copper rallies are being driven by aggressive fund buying and short covering against a backdrop of still soft downstream demand and weak Chinese bond markets, raising questions about how sustainable current prices are. In precious metals, rapid gains and thin liquidity mean attempts to call a top have been painful, yet the risk of sharp reversals is growing as positioning stretches. Over time, high prices may also trigger substitution away from copper and aluminum toward cheaper materials, which could cap upside. For allocators, key watch points are volatility in metals and oil, any policy response to inflation pressures, and whether January's powerful commodity moves persist or mean revert. Stepping back, the cross-asset picture shows a still supportive backdrop for risk, powered by record earnings, strong AI-driven investment, and resilient growth, but overlaid with important turning points in rates, FX, and real assets. Equities are broadening beyond megacap tech, while idiosyncratic risk and earnings sensitivity increase. Rates are anchored by cautious Fed, but challenged by fiscal expansion at the long end, and credit is stable, yet more issuer-specific. A weaker dollar is benefiting emerging markets and non-U.S. assets, while also encouraging a gradual shift toward real asset hedges, just as gold, copper, and oil send louder inflation and volatility signals. For allocators, the key will be tracking how far leadership rotation in equities runs, whether long end yields or commodities start to bite into growth, and how the dollar and policy path evolve through the year. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.